If you continue the four behaviors I am about to explain, they may quietly weaken your financial position over the next few years, and there is a high chance you practiced at least one of them this week without noticing. What makes this difficult is that none of these behaviors feel reckless. They often feel reasonable. Sometimes they even feel responsible. We are living through unstable economic conditions. Inflation has been elevated in recent years. Markets move sharply. Layoffs occur unexpectedly. Interest rates shift. All of that is real. However, long-term financial damage rarely begins with dramatic external shocks. It more often begins with small internal habits that slowly erode margin. You might relate to this. Your income is higher than it was 3 or 4 years ago, yet you do not feel materially safer. You read financial news and notice tension in your body. You delay reviewing your accounts because you expect discomfort. You reassure yourself that you will organize everything properly next quarter. I have observed this pattern across professionals, business owners, and families in multiple economic cycles. The people who build durable stability do not necessarily own the most. They tend to protect what others unintentionally allow to leak. A few years ago, I nearly drifted into this myself. Income was strong. Things felt stable. I relaxed slightly. Fixed costs crept upward. Investment structures remained loose. I postponed strengthening contingency reserves because nothing felt urgent. There was no crisis. Yet gradually, my margin narrowed. Income had not fallen. Outflow had expanded. That experience clarified something uncomfortable. Financial problems rarely begin with catastrophe. They begin with drift. Imagine your finances as a boat. The economy is the weather. You cannot control the weather. What you can control is whether there are small holes below the waterline. Most boats do not sink because of a single wave. They sink because water enters slowly and no one notices early enough. Later, I will explain the most overlooked leak, which even financially literate people sometimes underestimate. Let us begin with the first. The first financial leak is lifestyle drift. Lifestyle drift occurs when spending expands automatically as income rises. There is often no conscious decision to upgrade. It simply happens incrementally. You might upgrade subscriptions because they now seem insignificant. You might move to a slightly more expensive area without fully calculating how it affects long-term flexibility. You might increase dining, travel, or convenience services because after working hard, it feels justified. None of these actions are inherently wrong. The issue is accumulation over time. What this typically reduces is margin. It reduces optionality. It narrows your ability to adapt when income fluctuates. In volatile environments, elevated fixed costs increase vulnerability. If income dips, you cannot adjust gradually. Pressure increases. Pressure often produces rushed decisions. If you want to protect yourself from lifestyle drift, you could try 5 practical steps. First, when income increases, consider delaying lifestyle upgrades for 12 months. Allow the race to strengthen reserves or assets first. Second, direct a meaningful portion of income increases into investments or liquidity. Some use 50% as a guide, though the exact figure depends on your context. Third, calculate your minimum survival number, the monthly cost required for core stability. Fourth, review recurring subscriptions quarterly. Small amounts compound significantly over time. Fifth, maintain fixed expenses at a level that allows flexibility if income temporarily falls. Applied consistently, anxiety often reduces within months. Over years, resilience becomes visible. The second leak is attention fragmentation. Attention fragmentation happens when financial decisions become reactive because you consume excessive financial noise. You might sell after negative headlines. You might invest in a trend after confident social media commentary. You might revise your strategy every 6 months because a new narrative feels compelling. The cost is rarely obvious immediately. It shows up in disrupted compounding, in inconsistent allocation, in weakened clarity, Behavioral finance research, including work by Daniel Kahneman on loss aversion, demonstrates that humans tend to overreact to short-term losses more intensely than they appreciate long-term gains. This makes volatility feel larger than it is. Markets often reward disciplined systems. Constant reaction increases friction. To protect yourself, consider 5 actions. First, set fixed review dates, perhaps quarterly, and avoid daily monitoring. Second, reduce exposure to emotionally charged financial commentary. Third, write down your investment principles so they anchor you when volatility rises. Fourth, automate contributions to remove emotional timing. Fifth, measure progress annually rather than obsessing over short intervals. Within weeks, emotional intensity often decreases. Over a year, consistency typically shows tangible benefits. The third leak is deferred skill investment. This occurs when you postpone developing income-resilient skills because present demands feel urgent. You may delay learning about technological shifts such as AI because it seems overwhelming. You may postpone building secondary income capabilities because your current role feels secure. You may neglect strategic networking because it lacks immediate payoff. The hidden cost is leverage. Adaptability weakens. Negotiation power declines if industry conditions shift. Economic history consistently shows that industries evolve. Individuals who remain valuable are those who continue adapting. To counter this leak, consider 5 steps. First, allocate a few hours weekly to structured skill development. Second, identify one monetizable skill to deepen each year. Third, create visible proof of competence, such as case studies or public contributions. Fourth, nurture a small number of strategic relationships quarterly. Fifth, test small income experiments so you are not entirely dependent on one source. Within months, confidence increases. Over years, optional income pathways may begin to form. Now we come to the most overlooked leak. Identity lag. Identity lag occurs when financial behavior reflects who you used to be rather than who you are becoming. You might still think of yourself as someone not good with money despite increased responsibility. You might undercharge because you still view yourself as junior. You might avoid larger financial decisions because you feel unprepared, even though competence has grown. The cost is scale. Authority remains constrained. Momentum slows. Behavioral psychology consistently suggests that identity shapes action. If you see yourself as financially uncertain, behavior tends to mirror that belief. To reduce identity lag, consider 5 steps. First, write one clear sentence describing the financially competent version of yourself. Second, raise one boundary this month: pricing, standards, or investment thresholds. Third, track evidence of competence weekly so identity is grounded in fact. Fourth, spend time around people operating at slightly higher standards. Fifth, make one decision your previous self would have avoided. Behavioral shifts can begin within weeks. Over a year, trajectory often changes materially. Instead of chasing income aggressively, you might focus on protecting margin. Instead of reacting to constant noise, you might design systems. Instead of upgrading lifestyle immediately, you might upgrade assets. Instead of doubting capability, you might reinforce identity deliberately. When leaks are reduced, something subtle occurs. The nervous system settles. Decision quality improves. Opportunities become clearer because pressure reduces. Let us summarize. The 4 financial leaks are lifestyle drift, attention fragmentation, deferred skill investment, and identity lag. Economic volatility will continue. That is realistic. Structured systems, however, tend to endure across cycles. You are not someone waiting for luck. You are capable of building stability deliberately. If this resonated, comment "I'll stop the leaks." Writing it reinforces identity. If you want more calm, structured frameworks for building financial resilience in volatile times, subscribe. I will see you in the next one.